Hello and welcome to our video on the key metric of net operating income, or NOI. Now, this is one of the most commonly quoted metrics in commercial real estate, but also one of the most commonly misunderstood metrics. Now, the key to NOI, as we've discussed in the past, is that it's the direct connection between the operating profits of a property and the price. So NOI divided by cap rate equals the price. But one thing to note about the NOI that is quoted in a listing is that is the NOI that is projected to occur next year by the seller. So automatically we know that is going to be an overly rosy prediction of what the NOI will be. When you do your analysis, you have to think what it reasonably will be and then stress it so that if you lose a tenant or if COVID-19 happens again, you are not going to find yourself in a situation where you lose all your money. The next commonly misunderstood thing is people think NOI is cash in my pocket, but nothing could be further from the truth, and I'm going to show you why right now. Now, 99% of people that buy a piece of commercial real estate are going to buy it with a mortgage. Now, when you buy a property with a mortgage, they are going to require you to reserve or put money aside in an account for a rainy day. Now, that could include capital expenditures like I need to fix my roof, or I need to replace the HVAC unit in 5 years. So they want you to start putting away money today so that that money is there when it's needed in 5 years. They may also require you to do an interest reserve, which is basically putting a certain number of mortgage payments in the bank set aside so that if there are cash flow issues, they have the ability to continue to pay the mortgage payments while you solve the problems at the property. Now, if your property is not 100% leased, they're also going to require you to reserve for leasing commissions and tenant improvements. They may require you to do that if you're 100% leased. But those costs, all of those costs are coming out of your profit as the owner. These are not tax-deductible expenses, but they are expenses that you need to incur as the owner of the property. I know what you're thinking. Finally, we've come to the point where I have all the cash in my pocket, but you're wrong. This is the point where we get to net cash flow. And net cash flow is an additional metric that the bank is going to calculate in order to determine how much debt this property can reasonably support. So we have to take out our mortgage payments out of the net cash flow on an annual basis. And that's going to be a very large percentage of the net cash flow. Mainly because most people take out mortgages that are 70, 80% of the purchase price. And that's a huge percentage of the purchase price. So the debt service is going to be significant. You also have to take out income taxes. And I know what you're thinking. We already paid our taxes. But no, we paid property taxes. And now our property is producing income, so we have to pay income tax. But the nice thing is that commercial real estate is a tax-advantaged asset class. So you're definitely going to want to get an accountant with commercial real estate experience, because you can reduce that taxable income significantly and legally. That's very important. It's illegal to do this, but you need someone with the expertise to help you because you don't want to try to do it yourself. You'll find yourself in a world of hurt. But that is what gets us to cash-on-cash return, which is the cash we will have in our pocket at the end of the year. Now, it's very important that you understand this as a small balance investor, because otherwise you're going to find yourself in a situation where you're expecting one thing and the outcome is very different. So in the next video, we're going to talk more about the debt service and the mortgage payments and how to use those to increase your return on a property. So we'll see you there.